a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about China tech stocks and ETFs. So we know that last week was great for stocks. Major indexes recorded their best week since November of 2020, and some areas, particularly risk areas, high growth areas, they saw a dramatic turnaround, and particularly China tech stocks. The popular China tech ETF was up about 45% last week, though it is still down more than 60% over the past year and about 20% year to date. So we saw some relentless selling in Chinese stocks, and over the past year, these stocks have been beaten down mainly due to regulatory concerns, and then over the past few days, there were some other concerns since the war in Ukraine started. China's ties with Russia, those worried some investors because we know that Russian stocks have become almost worthless, and major index providers, in fact, like MSCI and FTSE, they have thrown Russian stocks out of their emerging market indexes because they have become uninvestable. So some investors feared that some Chinese companies may also see some sanctions because of their ties to Russia. And then there were rising cases of COVID in China. And Chinese government follows a zero tolerance policy, so they lock down the entire city even if there is one case of COVID. So those renewed lockdowns, they sparked concerns of economic growth slowdown, and Chinese economic growth has been slowing down over the past few months. So that was another area of concern. And then adding to worries were some regulatory developments. The SEC said they named 5 Chinese companies that could be delisted from the US. Now, after this relentless selling, Chinese regulators, they announced some market-friendly measures, and they said that they support listing of shares overseas and market-friendly policies. So some investors thought that these stocks had become too cheap, so they bought the dips. JP Morgan had recently called these Chinese stocks, particularly 28 Chinese stocks, that they have become uninvestable over a 6 to 12 month horizon. So it remains to be seen whether these are screaming buys or they are uninvestable. But remember that these are going to be very, very volatile, and most likely the movements will be driven by headlines, news headlines, and not by fundamentals. Let's take a look at 2 popular China tech ETFs. So the most popular China tech ETF is by CraneShares. Ticker symbol is KWEB. And this ETF has been very popular with retail investors, even though it was down a lot over the past year, as I mentioned, over 60%. But it saw massive inflows last year, about $8 billion in inflows last year because investors were buying the dips. Lately, it has seen some outflows, some minor outflows. So this holds Chinese internet companies which are listed overseas in Hong Kong or in the US, has 50 holdings, 5.9 billion in assets currently, and has an expense ratio of 76 basis points. To learn more, you can go to the quote page on Zacks.com. Using the link, you can go to the external home page and see what it does, what it currently holds. So Chinese securities, China-based internet companies, which are listed in Hong Kong or the Nasdaq or NYSE. Now you will see that it is pretty top-heavy with top holdings: Tencent, Alibaba, JD.com, BIDU and Meituan, they account for 45% of the portfolio. Now, as I mentioned, there are lately concerns regarding delisting of Chinese companies from the US exchanges, and the SEC had named 5 companies. So, in response, Crenshaws announced that they do not hold any of those 5 companies identified by the SEC which are not in compliance with this act. And they also said that they will convert the majority of holdings to Hong Kong listed counterparts, not US listed, and they expect the portfolio to be comprised of solely Hong Kong listing by the end of the year by converting US ADRs to listings in Hong Kong. The second most popular China tech ETF is by Invesco. Ticker symbol is CQQQ. This also holds Chinese tech stocks, but it holds shares which are listed in mainland China and some in Hong Kong. This is more diversified with 127 holdings, smaller than KWEB, but still quite popular with over $1 billion in assets, slightly cheaper with 70 basis points expense ratio. Again, you can go to the code page on Zacks.com and the external home page. So Invesco shows you what it currently holds. So these stocks, China A shares, China B shares, China has so many confusing share classes if you look at the portfolio. So listings in China, but you will get the same company, Tencent, Meituan, Baidu, and some companies which are not included in the KWEB ETF. These are smaller companies and more exposure to Chinese domestic economy. Now, on the next slide, I have the comparative performance versus the S&P 500 index and the QQQ index, the NASDAQ 100 index, because these are technology stocks. So you will see that over the past year, the Invesco product is down about 45%. The KWEB ETF is down more than 60%, whereas the S&P 500 and the NASDAQ index, despite the recent selling, they are both up between 12 to 14% over the past year. I also looked at the long-term performance of these two ETFs versus the QQQ and SPY, and you will see that since Crenshaws CWEB inception in 2013, August of 2013, the KWEB ETF is down. The performance is almost flat after all these ups and downs. The Invesco product has significantly outperformed KWEB, and both are down significantly compared to QQQ. QQQ has delivered an outstanding performance, and these both are down even compared to the S&P 500 index. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer, and make sure to subscribe to our videos so that you do not miss anything, and I'll see you next week.